So when we talk about IBC or infinite banking, okay, give me the 45-second version of what is IBC.
Before we hit what is, one thing to really, really understand about it is that this is not a product to be sold. It is a process. And that is on the first page of Nelson's book. Yeah. This is a process for you to understand money and build an economy within your family and in your circle that you own, that you control. Yeah. And that is the whole idea behind it. And that's why that whole book is based around ownership. Okay. So to get outside of that, what is infinite banking? It is literally nothing more than a pool of capital, a place to warehouse your savings, that you own it and control it, and you can utilize that in one of two ways, either to pay off liabilities you have or to increase assets that you have. Okay. And it goes back to one simple premise, and everybody hear this: there's a cost to everything you and I do. Here's what I mean by that. You're either going to go buy a car and you're going to pay interest for using someone else's money, i.e. the bank, or you're going to give up interest you could have earned by paying cash, meaning you're going to take money from a CD, a savings account, a money market, a mutual fund, or a stock. You're going to take money from somewhere that was earning interest and you're going to pay cash. Yeah. So people don't think about this, but either way you go, there's a cost. You're either paying interest or you're losing interest you could have earned. Correct. So what Nelson wants to do is show you a system where you can recapture a portion of that interest you were paying or a portion of the interest you're losing, put it in your own pocket, and your pocket then grows by definition. And then then it becomes, okay, where do you put it? Yeah. So that's where people, unfortunately, have the arguments. Okay, where do you put it? Sure. But the concept itself is identifying there's a cost, creating a system to recapture that, so that your wealth, your pocket now grows by definition. That is as simple and fundamental as you can make it. And I think you and I would both agree, if you were paying interest to a bank and I could show you how you could put some of that interest in your pocket over the course of your lifetime, how much better off would you be?
Yeah, and you would do it.
Yeah.
Okay, so you've got IBC, infinite banking concept, which is run through whole life insurance policies, correct?
Yep. So at some point that wealth has to reside somewhere.
Correct.
We talked about Joseph. Where did he build it up? He built the stalls and said, we're going to store the wheat and the food there. All right. So we have to have a warehouse.
A warehouse meaning a place to hold it.
A place to hold it. Yeah. Where's your money residing? Yep. So there's only a few places. There's three places you can park money: in a taxable account, which is a CD, a savings account, a mutual fund. You can park it in a tax-deferred account.
When you talk about a taxable account, when the money grows, you are taxed on the money that grows. Put $100,000 in, you make $10,000 of interest. You're taxed on the $100,000. You're taxed on the $10,000.
That's right.
All right.
Yep. Great point. So the second place is what we call tax-deferred accounts. Okay. So these are places where you put $1, you don't pay tax on it, but it grows, but when you pull it out, you pay tax on whatever income bracket. That's an IRA, that's a 401k, it could be real estate. Sure. It could even be business equity if you're a business owner. So it's deferred to the future. Then the third place is what we call tax-free. So Roth IRAs are the number one place people think of when they think of tax-free. So that's after-tax dollars that you can put in, and then you never have to pay tax on it again. Okay. So those are Roth IRAs, and then when you design it properly, life insurance. So specially designed, properly designed life insurance. Basically, all that means is not the traditional way. Most of the time, people think of life insurance for what reason?
So if in case you die, everybody gets paid.
Yeah, everybody. Yep, death benefit. It protects you, right? So you want to get as much death benefit as you can for as little money as possible. At that point in time, life insurance is an expense. Sure. And we're taught to minimize expenses. So here's what most people would tell you, and they're not wrong. Some of the people that you get their books and you see them on television and advertising on the radio, the financial geniuses, they will tell you life insurance is a bad place to park money. Life insurance is not a good investment. And here's the truth, they're right. If you buy it for death benefit, They're exactly right.
It's not good.
It's
You're
not
correct.
good. So they're telling you the right thing. What Nelson showed me that I didn't know, and what a lot of people in our industry, it's catching on, but what a lot of people don't know is that you can design it in a different way. Instead of solving for that death benefit number, you can actually solve it to build up capital. Yeah. And minimize the death benefit. So think about this, and just kind of go with it for a second. If you're maximizing the capital that you have in a policy and minimizing the death benefit, and it's set up to grow every day, every week, every month, every year, it has now become an asset.
Yeah.